Hello, everyone. Welcome to the podcast, second episode. And we have an amazing guest today over here with us. His name is Chair Powel, and he did his studies in Penn State University, where he obtained his bachelor's in information sciences. And then he began his career as a consultant. And afterwards, he had a lot of work experience in financial services industry, working as a financial services professional himself. And of late, he started his own venture that is ClearPeak Capital Management. So he is someone who is, deep into financial industry and someone from whom we can learn a lot. So welcome, Jay, to the podcast, and it's great to have you here.
Thank you, Edvit. So yeah, I started ClearPeak Capital Management probably 3.5 to 4 years ago. Um, and it was right after the whole COVID time of, you know, everything's just going up. You have overnight millionaires in different places, and there was too much greed in a small, short window of time that I thought people could use my help in managing their portfolios better. And some of the things I saw in the market really pissed me off. So that's what led me to starting ClearPeak Capital Management. And now we work with a variety of individuals, mainly business owners and young professionals. So specialize in portfolio construction mainly. I think that's my strong suit. And I'd say most of my clients are fairly high risk, but when I say high risk, it's more equity allocations. No one by high risk, I don't mean, you know, Kathy Wood's ARK Innovation ETFs or a lot of crypto speculation and things of that nature. So yeah, everything we discussed today, I mean, it's for entertainment purposes only. I'm not here to offer financial advice. Edith and I are going to discuss things I've been seeing in the markets and trends, macro focused, and just things I like and some things that I've learned through the years that I think would be beneficial to a general audience such as yourself. So thanks for having me.
Thanks so much. And actually, it's no better time than this, to have a conversation with someone who has really worked in financial industry and who has seen, from deep lens and clear trends. And what I see is a lot of people, the literacy or the financial acumen is not that great, especially after COVID, when people, as you say, become overnight millionaires. So right now we need, a good, knowledgeable people like yourselves to guide us and to share, wisdom that you have accumulated over the years of hard work. So there's no better time than this. So I'm really glad to have you on.
Thank you. I'm glad to be here.
Sure. So if people want to, just before we start the conversation, if people wants to know more about your services and what you do you? I know that you used to blog. So if they want to know, or get to know you, then is there any way they can, find your research or find your work?
Yeah, so I actually haven't been posting much this year. My last big post was I wrote my firm's outlook in January. That's on my LinkedIn. I guess if you search up J Patel, ClearPeak Capital Management, I should be up there. I know there's a lot of J Patels, but I think if you search ClearPeak Capital Management with my name, you'll find me. And if you go on clearpeakcap.capital, so no .com, just clearpeak.capital, that's our website. And I want to get back to posting more. I haven't had the time this year, but I think I'm going to be more active on LinkedIn than the website.
For sure, for sure. For those people who want to know more about this, I'm gonna, put the link in the description below so that you can go there and check it out. So yeah, without further ado, let's start the meat in the game. So we can start with the presentation, right, Jay? Over to you.
Yeah, so let's start with just general market so far this year. I mean, I know last year was let's go back even further. This chart doesn't go back further, but if we were to go back to 2020, we'll call that and everything rally. 2021 kind of continued, and then 2022 was really a washout and a healthy correction, in my opinion. You can't just be going up all the time. Sometimes you need to take one step back to take two steps forward. And that was a year where were the most beat up. We were starting to get high inflation scares. We had the fastest increase in treasury rates ever seen in the United States and a lot of other places in the developed world. So that scared a lot of investors. It scared markets because markets hate uncertainty more than anything. So inflation and the Feds of the world trying to fight inflation gave us a nice healthy washout, which was largely the drawdown was largely led by larger, bigger cap names. But then 2023, as we approached 2023, everybody kept saying recession, 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 and it never came, right? So I know in 2023, the question was, or is there going to be a soft landing, a hard landing, a no landing? And we went through 2023 without losing a single job in America, and the market continued higher, and the state of the economy is just tremendous. I mean, so if you live through 2023, there's you lived through the soft landing. The soft landing was here, and we're probably still living through it. And that's my take on how we got to here today, 2024, where we are year to date. But the thing about last year and as we've continued this year is market concentration, which is at an all-time high. I think the top 5 to 10 names of the stock market make up roughly 32 to 35% of the S&P 500. That's pretty unhealthy. I don't like seeing such concentrated markets. I don't think any investor does, or any asset manager. It makes our lives harder for sure, which is it's tough for anyone to compete when 8 names are dominating the market. And I think who was recently removed, I think it was Tesla, and now Apple is getting kicked out of that Super 8 Magnificent 7, and now it's what do they call it now?
Fantastic Four.
Fantastic Four, yeah. So it's like what, Nvidia, Meta's probably in there,
Yep. Google, I
and
guess.
Microsoft, and I don't know if it's Google. It's probably Google, or maybe Amazon, but I don't want to say Amazon just yet. So yeah, it's Fantastic Four. But see, this kind of concentration, it was around in the 70s. It was around the time of the tech bubble, but we saw a really nice rally in the market. We saw a lot of breadth where up to at one point this year, 80% of stocks were above their 200-day moving average, right? So I like when a rising tide lifts all boats and not just a select few. It's it's a healthier market when there's more stocks winning than just a select handful of names. But if we go on to the next slide, so this is from JP Morgan Asset Management. They have what's called Guide to Markets, and this is a public presentation that's updated daily, monthly, and quarterly. Some slides are updated daily, but it's just a great macro insight into the overall market, the economy, and the bond market as well, and some alternatives if anyone's ever interested. It's just a great free resource that I look at fairly often. So yes, we're very concentrated right now, much more than we were during the tech bubble, but in terms of valuations and earnings, it's nowhere close. So when I don't like that word right now, bubble, we don't live in a bubble currently. We live in a concentrated environment. It's much different than the tech bubble of 2000 because like we saw Nvidia's rise this past year. And the reason for that rise was they just kept crushing expectations, and their valuation is cheaper now than it was last year, 2 years ago. So a market driven off earnings is healthier than a market driven on PE expansion. But right now, the problem is that the only companies that have these strong earnings are those super eights, those magnificent 7 names. They probably accounted for 90% of earnings growth last year. So that warrants the concentration. The issue now is when will all the other names start growing their earnings? And right now, one of the biggest problems is that when earnings stagnate, how do you, as a smaller company, grow your earnings if you can't increase sales at the pace that the bigger name companies do? One, you either have to innovate. We live in America. We will always continue innovating. I think we're much better off than a lot of other developed countries in terms of how our politics help out business practices. And if we look at new business filings, you would think it peaked in 2020 when people were home. They're like, let me start a side gig, let me start a business, let me get away from my 9 to 5. I like working from home. I'll start something for myself. But no, they've stayed just as high, and they peaked. I think it was in 21 or 22, and the numbers are still there in terms of new business creations in the United States, which I like to see because if you remember back then when interest rates were zero, no one was really creating anything. It's, oh, I'm gonna release this token, I'm gonna release this NFT. Let's trade pictures of apes on boats. So I think higher interest rates and seeing new business creation, I think that's a great pairing for the future, because it makes people, money's not free. So if someone's backing them, they have to create something of value now. And we've started to see that with a lot of these new AI startups, which I hope someday will translate into things like robotics. I don't know, it could be a sidewalk sweeper for in on city streets for all I care. I think that would create more value for society than trading images of whatever animal on what in whatever car or boat you name. So we're starting to go there. And another thing with smaller companies is, in order to grow earnings, we should have been seeing layoffs. We haven't. In fact, we've had the opposite problem of smaller companies and small businesses not being able to find help. So let's see what happens on that front. I'll touch on that a bit later. But if you look on this slide, it says earnings contribution of the top 10 in the S&P 500. You go back the past few years, and the only companies that have really provided anything to the market were those top 10, accounting for 32% of earnings contribution. So I'd say their performance is justified in a concentrated market. And if we continue on, like on this Y chart slide right here, if you invested last year in just the biggest companies in the US, you almost doubled your money. Whereas the rest, it was I don't want to say average performance. 20% isn't average performance by any means, but we got the bulk of that performance in the last quarter. So that rally I was talking about, the surge in breadth where the tide lifted all ships, that didn't come until October, November, when I believe inflation came in at 3.2%. And everybody kind of had a cheer and a hoorah of, we're almost done with this whole fight, until last week where we came in at 3.5.
Yep.
And now today, Powell was saying we may have to dial back rate cut expectations. So that's really thrown a wrench into smaller cap names, mid cap names, longer durated treasury bonds. So let's see where we go from here. I mean, we'll talk about the Fed now, since we're on that topic. I like to compare the 2-year to the effective federal funds rate. I think it's the best indicator. If the Federal Reserve didn't exist, then I think we should just be using the 2-year as an effective, not as an effective rate, but as where should we hike, where should we cut. So this, you see that big dip in the 2-year, and that was the last quarter of 2023. But as inflation expectations inch just slightly higher, we have this big increase in the yield for the 2-year. But I think right now, with interest rates came in at 3.5 last week, CPI, the biggest component of CPI is fairly lagging, and that's housing and rents. Those have been trickling down, but we'll be seeing energy prices that have been increasing this week. That'll probably factor into next month's report. So it's one of those things. If we're wiggling around from 3.2 between 4, I wouldn't necessarily be panicking. 4% from where we were is still less than half from 9% a year and a half, 2 years ago. So we're still in a deflationary environment, which is good, but it calls for caution, not for freaking out and changing up your entire portfolio, in my opinion. And if
So,
we go on to look at, sorry, what do
so yeah. So just for the viewers to understand, let me
oh yeah, I gotta let you
put it
talk
on.
too.
Yeah, let me put it some things into simple words so that everybody can understand. So what we are talking about over here is the relation of inflation, interest rates, and 2-year treasury bonds, right? My one question to you is, since we have seen the last mile of inflation as is proving to be sticky as of now, at what point does Jay Patel get convinced that this is not just a caution and it is something bigger than that? Is it like what's the time horizon? Like how long can U.S. economy survive 5.25 terminal rate? Because right now we are it seems we are doing completely fine. No job, like job numbers are good. Everything else is falling, in perfect place. Like right now, I don't see any systemic risk. So till what point, Fed can keep this rate, this year, 6 months, like till what point we should worry as normal day-to-day Americans. That's the question. Because like we understand, inflation is sticky. We understand interest rates are high. We understand Fed is determined to fight against inflation. But then at what point we should worry?
So we talked about systemic risk. So we thought, what would break, right? The banking system had its, I don't want to say breaking point, but with SVB, First Republic, I think it was First Republic,
Yep.
the Fed stepped in and we now have a higher FDIC limit and so forth. They used some tools and they solved it, right? So nothing broke there. We thought higher interest rates would lead the housing market to break, but that hasn't happened. And the main cause for that is we have a big generation of people our age in their 20s and 30s who are looking for a house, but America's so underdeveloped from 2008 that there's not enough houses to go around. So basic supply demand imbalance hasn't caused housing to break. And I don't think housing can break at this point, because if you and I were to buy a house, we probably should be looking to buy a house this year, because we would be able to lock in a high rate, save a little bit, and then refinance once rates are cut, or to a point where we get comfortable in the next 2 to 3 years. So if you can afford that higher interest rate, then there's still a lot of buyers right now for homes in the United States. There's just not enough homes to go around. And then employment, I mean, we thought with higher rates, companies would start laying off workers, and they did at one point, but there were enough jobs to go around that higher rates did bring that imbalance not back into line yet. But if we look at job openings and workers in the United States, there's still a slight imbalance. I don't know the exact number, but at least it's not where it was before, where there were two jobs for one worker. So high rates would, if we continue with high rates, it'll help close that gap, I believe. But the biggest thing when it comes to rates and inflation is the Fed wants to see that inflation is lower than wage growth, because you have to protect the prosperity of the American worker. And right now, inflation is finally lower than wage growth. So your your earnings are, you're working for yourself. Your labor is growing faster than your money's deteriorating, which is the most important thing for Jerome Powell, in my opinion. But like if you said, how long can we sustain this? It takes 9 to 12 months for rates to trickle their way into the economy. I don't know, how long have we been at these high rates at this point? It's 6 months now since we've had an increase.
Okay, because what I'm seeing is, if we get, so now there are only two CPI inflation data before the FOMC meeting, right? So if we still hover around 3.5, or let's say more than 3.2, then June is off the table. So I was just kind of wondering, like, since this is an election year, and if at all something will break. But right now, the economy is so strong that I don't see anything breaking. So that's why I wanted to,
And
get your
I
thoughts
mean,
on it.
the biggest risk to the market is an unknown risk, and it's something you don't see coming, right? So kind of like what happened in 2020, what happened in 2009 tech bubble. The biggest risks are something you don't expect. And we thought, you said it's an election year. So I actually talked to someone about this yesterday. He made some very good points about how Powell will have to navigate hiking or cutting in an election year. So let's say inflation does kick up. Powell has to win this inflation battle, because he was wrong once. As a Fed chair, you're not allowed to be wrong twice. If you're wrong twice, you lose your job and you go down in history as somebody who was really bad at his job. And I think the last thing Powell needs is to go down as one of the worst chairmen of all time. And he wants to keep his position as apolitical. So he's not going to cut or increase before the election. So forget about the
So this is a
any Fed actions in September.
so
Or
we are in a perfect gridlock,
yeah,
if I am assuming correctly. So gridlocks are better for the markets, don't you think? Like, no news is good news, right?
yeah. No news is good news. You continue doing business as you can. did business yesterday. So the market loves when we have a divided government, and right now a gridlock would help this election cycle. But back to the point of Powell, I mean, if you look at the CME Fed Watch tool, it drastically changed yesterday. We're not going to have any change in interest rates in April. I mean, or June. And personally, I don't think we'll have a cut in September or November. I think if anything happens, it
Wow.
has to be in December after the election.
And if I may ask, like, what makes you think that? Like, not even a 25 basis point cut?
If we get it, it would have to be in July.
Oh,
Because if
this is
Powell does
interesting.
it late in the summer, early fall, then it I don't does it meddle with election outcomes?
Makes
So
sense.
that's my thought. If you don't want to meddle with election outcomes, you can't be doing it in September or November when the election's heating up.
So all in all,
It has to be July or December. So that makes his job even harder now.
oh my God. So all in all, it's higher for longer, people. Brace yourselves.
I mean, how long can we go with this? I don't know. We've been at it for a year and a half and nothing has really happened. And I
So,
think
so,
another 6 months isn't gonna do much.
so, regarding this, like, what are your thoughts on the overnight lending facility that Fed created for a year, and that is supposed to get due this year? So, won't that be any issue to the financial system?
I think it's more of a I'd say if they keep rates high, it'll create a slight amount of stress for smaller banks. But I think from last summer with the whole banking crisis, they've got things back in order to a point where it was to help smaller banks, right?
Yeah,
Get back on their feet and continue to do things the right way. That rolling that off won't really, I don't think that's too big of a risk at this point because now we know the risk. And
so
the
that
Powell still has tools. If he needs to get back on doing repos for overnight lending, then he will.
makes sense.
Because that's
Makes
one of those
sense.
things your average person doesn't think about. So if he does that even in September or November, it's not going to be considered election meddling.
Makes sense. So, if all of this is priced in, so I don't know why, but I'm getting a feeling of we are due for a good rally at least mid-year before the elections. Because if all of these risks are priced in to the market right now, then uh, I don't see any bearish factors. Like we already have a 5% correction. Everybody knows that we are higher for longer. So now I think we are in a good time. You know,
I mean, I'd say so. The bank earnings were pretty good today, and let's see what tech has in store in the next couple of weeks. So we started earnings season off not too bad, and I mean, a 5 to 10% correction, it happens almost every year. 5% correction is very common. A
yeah,
10% correction happens at least annually. So, I mean, I'm not too worried about it because election years are usually bullish, and when you have a divided government, it works to the benefit of the market. And if we are higher for longer, now we at least know. But then again, you have to think, what does inflation have in store? I think the most important things are going to be inflation, earnings, and those are probably the two biggest things in my opinion.
great, great.
The two things that matter most because we want to see earnings broaden out instead of being concentrated in those top names.
So, do you see any risk in terms of earnings not broadening out? Because I think the higher interest rates doesn't affect the large corporations much. It does affect the smaller, businesses much harder. So, my question to you is like, do you see more broadening happening? Because now they are under more stress, right?
Yeah, I'd say it's higher for longer would not help the broadening of earnings because it would just continue higher interest expenses. And as debt comes due for smaller and middle cap names who are more reliant on borrowing, and I mean, Apple, Google, Microsoft, those guys can go issue bonds at low yields. Whereas smaller companies, small cap names, you can't just go issue debt. I don't even know what it would come out to be. It'd be in the high yield space of anywhere from 7 to 12%, maybe even 15 for newer companies. So that definitely eats up at on the balance sheet, number one expense, interest expense. So that's been the biggest thing with small and mid cap names is these interest expenses. And I really, we'll talk about small and mid cap names. We actually have some slides dedicated to it. Will
Great.
come up here shortly. So let's discuss that then.
Sure, sure, sure.
This is just prosperity of the American worker that I pointed of Powell knowing when um, he hasn't won the war on inflation, but he's starting to get there is when wage growth is higher than CPI. But also, why was it such a big deal that we were at 3.2% in November? Stocks historically do well when interest rates are between 2 to 3. So creeping more towards 4 or 5, we had that 5% correction that you're talking about in the past few weeks because of 3.5 print. It's in line with historical averages, the correction and performance. Anything else you want to touch on before we discuss small, mid, equal weights, market cap weights, and such?
Uh, no, I think I'm good. Yeah.
So, I mean, we were talking about small and mid caps, right?
Yep.
Their performance has been relatively flat since 2022. And it's, like we said, interest expense, not being able to grow earnings in a high inflationary, high interest rate environment. But right now, I really like small and mid caps. People who think the market's overpriced, the market's expensive, small and mid caps aren't. They're trading at some of the cheapest levels compared to larger cap names. And we saw the performance of the Magnificent Seven a while ago and the other 493 stocks. The equal weight would do very well in a broadening out. The equal weight right now is lately for the past decade or so, equal weight performance has mirrored mid cap performance. And I think it's just that larger companies have gotten so big, whereas if you're the 300th or 400th or 500th company in the S&P, you're closer in size to some of the biggest mid cap names in the S&P 400. And I'm going to say one thing right now, just one quick thing. I use the S&P mid and small cap indexes. I don't like the Russell 2000. The Russell 2000 does good when you have super, super high breadth. Like I'm talking like in 2020, unheard of kind of market breadth. There's just so much junk in there that I like the S&P indexes because they have a quality screen. The only way you can get in the S&P 600 as a small cap name is you have 4 consecutive quarters of earnings growth or positive earnings. So that automatically gets in all of those unprofitable, highly volatile names that you would find in the Russell too.
So let me stop you right there. So this is really important for the viewers to understand. And you put down a very important point. Normally what happens is uh, anybody who is watching this will have 401k portfolio. And in that 401k portfolio, the options that you get is if you want to be aggressive, if you want, high returns, what they, point you towards is the Russell index. And you make a very, very important point over here that if you want to, go with small cap names or let's say, smaller companies, then it would be much better to go with S&P 400 or S&P 600 names as opposed to the Russell names, because as you rightly pointed out, the criterias or the screening is way better in S&P. So rather than going with a fund that is mirroring Russell, I would rather bet on a fund which is based or allocated highly on S&P 400 or S&P 600. So that is very important differentiation that people should know, that you have quality stocks at your disposal as opposed to the mainstream advertised index. So this is really really insightful. Yeah, please continue.
I I like what you said about how to allocate in a 401k. My only concern there would be good luck finding any 401k plan that uses S&P 400 and 600 indexes versus the Russell 2. In all the corporate jobs I've worked in the US, I've never had a 401k plan manager that offers something besides the Russell 2. And if they do, it's an active fund with a higher fee.
So since you pointed out, I'll just take 2 minutes and pardon my rant because so I worked in a small
Please rant.
startup, because the reason why I'm doubling down on this discussion is because a lot of friends, a lot of people who are in 40s, 50s, even they don't understand this, and that is why it's very important to explain them that doing 401k, investing for retirement is good, but there's a huge caveat, and that is, like any company you work for, there is a very high chance that you only get 9 to 10 options, and most of the time those 10 options are very, very bad for you. And why they are bad for you? Because there's a vested interest in giving you those options, and the very fact that you can't choose your own choice tells a lot. So and those
I'm going to
target
stop
date
you
funds,
right there.
and
I don't think
it's
I don't think they're the worst options. Your average 401k plan, I don't think the options are that bad. It's just it's I think you're probably more pissed off at the fact that it's not as customizable. But
absolutely.
then you have ways to roll over that money and self-manage. But then I think when your average person goes to self-manage, they start picking individual stocks, buying whatever ETF is available, because then you have unlimited choices. It's just like a brokerage at that point. So do you think it's better that the average person has only 10 ETFs or index funds to choose from, or do you think it's better that they have infinite? So I don't I'm also with you. I'm pissed off that there's no equal middle ground with
Yep.
more
So
index selections for broad market allocations. But it's either
so
you get
the
these 10 that we know that work and have created a lot of wealth for people in America, or you can just go Wall Street bets or 401k.
what I think is a simple change in those plans of allowing people to at least go with benchmark products like QQQ or SPY. Even that would be very, very beneficial. And the reason I'm saying this is because we don't have that option either. So let's say I want to completely invest everything in SPY only. That is the ETF, not even the fund. It's ETF, right? I don't have that option. Neither I have an option for QQQ, neither I have an option for Russell ETF, because when I invest in the
There
fund,
should be things similar enough. I know a lot of 401ks offer the Vanguard funds, which mirror
but then
performance. It
they
might be like 4 or 5 basis points off
so they
SPY,
have,
but
yeah, but they have other caveat as well. So those they what they provide is the funds with high expense ratio. So when you go, you're losing 1% straight away. And rather, as opposed to ETF, you just buy it and keep it, right? You're
the
not
Vanguard
paying.
funds are 3 basis points in expense.
Oh, I
The
didn't know that.
Vanguard
Oh,
S&P
okay.
500 fund institutional share class should be 3 basis points. If someone's charging you 1% management fee
The
for an
problem is,
S&P 500 or broad market fund in a
uh
401k, I'd like to know who the hell that is, because
because
now
what
I'm
I
curious.
yeah, because so when I used to work at a company, I would not name the company, but so the problem is when I
We'll go on your
compare.
LinkedIn and find out.
For sure, for sure. So when I used to work for that company, and when I, take that fund, go to Google, track the performance, if it's the same fund, then at least it should give me the same return, right? You go to SPY and then you go to that fund, the performance is like massively different. So something is fishy. I mean, I don't know if it's allocation, or I don't know if it's fees. I don't know what it is, but
I
the
think
performance.
it's probably a mix of allocation fees and
So there you
I
go. That
don't
is why
know
I
much.
say
I
it's
don't
the
know
most shittiest
enough
thing you do.
about 401k and ERISA law right now to give you a clear-cut answer. It's just
Yeah.
I haven't had that in my personal experience. So one, I can't relate. Two, I'm not too well versed on the fine print of 401k plans usually, because I've never really seen myself or a client have funds that are such a high fee.
So normally, so me being me, I researched all the 10 options that I had in with my past company. So it was crazy. Like it ranged from at least 25 basis points to 1% expense ratio, right? And I was blown out by, like if you have these options in your 401k, you are ripped off straight away. Forget about the performance. You are depleting 1% every year just by doing nothing. So,
So
compounded that with 40 years.
here's what I think's going on there. Whoever's in charge of institutional fund sales for the companies providing the funds at your previous company and the advisor working as the 401k manager, he's probably getting fed some very nice fancy dinners on a monthly basis to get
Absolutely.
all that junk in for employees at your previous company.
Yeah, I mean, the whole idea of this discussion I wanted to emphasize on is for people to go on their portal and do some research if they are being ripped off or not, because it will be helpful for them in the longer term, given the compounding nature of, our life investments, right? So it's very important, no matter who you work for, please check your, money, where it is going, what are the terms and conditions, because so here's another thing. When you go to the dashboard of some of the portals, they tweak the numbers in such a way that the higher the number, they'll show only that number. So, for example, if markets behaved well, so they'll only show year to date so that they show the best thing. But if you actually sit and calculate your contributions as opposed to the growth, then you actually come to know what's the return. So all of these things, I just wanted to, showcase or, discuss so that people know what they're buying and what are the terms and conditions, right? So that they can make an informed decision.
I think general rule of thumb is simple beats complex. And the nature of a 401k is you're adding money to it every paycheck, right? So you're dollar cost averaging. So if you're going to dollar cost average into something for your entire career, keep it as simple as can be. Simple asset allocation, low fees. You're adding to it every 2 weeks or every week, depending on how you get paid. It works for you. It's been the biggest wealth creation machine in, I'd say, modern history. So let it work as intended.
So before we move on to next topic, one last question. According to your, perspective, people who are, starting their careers, and I'm sure a lot of listeners are, new to the workforce, and they want to build a very good, sustained nest egg. What should they prefer? Should they prefer the retirement, like 401k, Roth IRA or something? Or as opposed to, they should prefer someone like you or a financial advisor. And the same way they are contributing to the 401k, they should contribute to an active fund manager. So, what's your take on this thing?
Um, One, I think you start off with your 401k, and then depending on your income, you go Roth IRA, and you continue maxing out your 401k contributions. Then you see what tax advantage accounts am I eligible for, and then whatever's left you do in your own personal brokerage in CDs, depending on how much risk you want to take. Like if you're saving up for a house, or if you want to continue that high risk at a very young age out of college, that's obviously your choice. Um, And there's a lot of self-directed robo-advisors too for people who want to invest more but don't have the capital or minimum for certain professionals like myself. Because I think one of the biggest problems with advisors is someone will be like, "Oh, you don't have at least $100,000, $200,000. I mean, come back to me when you do. I don't want to work with you," type of thing. So there's a lot of fee-based advisors as well. They work kind of like accountants, like, "Hey, here, I did this for you twice a year, quarterly. You owe me this much." That's not a bad idea. But I think if you can be well read enough and well researched, there's a lot of free tools out there to help you make these decisions, to better empower you to make these decisions, to give you more knowledge on it. And I think if you're going to go that route early in your career, that's not a bad idea. Just avoid CNBC, avoid Wall Street Journal, Motley Fool. What are some other places that
Yes,
always have what should you do with your Roth IRA? It's like every 2 months they have the same fucking headline.
Jim Cramer.
Pardon my language.
No, no, no worries. Cool, cool. So yeah, there you have
So
it, folks. Be well read, and this is a really good roadmap, actually. In real world, start with 401k, max out if you want to, and then slowly and surely, when you have a lot more capital to deploy, then you can go via active fund management route, right?
also I'm
So
not active. I think I'm a mix of active and passive. I'm not a stock picker. I actually wrote about why I'm not a stock picker on my website. And if most stocks fail in their life, meaning they have a drawdown of 60 to 70%, and you're going to buy stocks thinking, "I'm going to own this my entire life. This is the next Apple or Amazon." Well, you're already playing a losing game. I mean, think about how many times the top 10 names in the S&P 500 switch. Every decade, you have a new top five, right? Who would have thought NVIDIA was going to end up in here 10 years ago? Who would have thought in 2000 ExxonMobil or IBM will get kicked out? So it's being a stock picker, I think, is one of the hardest things anyone can do consistently. You know, that not too many people are Warren Buffett and Charlie Munger, rest in peace. Charlie Munger, excuse me. But it's near impossible. So you're already playing a losing game if most stocks lose 60% of their value and never recover. And then finding the next 10 bagger, your odds are 1% of that. So it's like looking for a needle in a haystack.
So this is a really important point. Let me put it into simple words a little bit. So a lot of people working their day jobs, 9 to 5, from different professions, still firmly believe and think that they will be able to, find the next multibagger or find the next Nvidias of the world. But just know that the mathematical probability is against you. So you want to do something, by all means, go ahead. But history and mathematics is against you. So
Oh yeah, perfect. Next point. We'll prove this. Forget the S&P 500. If we look at the equal weight, 90% of fund managers don't beat the S&P 500 equal weight.
wow, wow. So
And
this is really important.
so we look at this chart, right? And it shows the equal weight lagging the S&P 500. Well, when interest rates and inflation are high, companies who have very low interest expenses and the biggest firms do the best. So that's why we've had such a concentrated market.
So
But
guys, just to simplify this, what he's saying is a lot of people don't know this, but I'm just simplifying this. So when you see SPX or S&P 500, when you say S&P 500, that index has two types. One is the equal weight and another one is the market cap weight, or whatever the criteria is. The thing is, what we are looking for as a general public is most of the times in TV or in headlines, that is a market cap weighted index. So just so you know that that index that you see is, changing through the market cap. So it's not like all the companies have equal, chunks of that index. So what he is showing over here is the equal weighted same index, the same S&P 500, the performance of equal weight and, the market cap weighted index differs a lot. So that's what he's explaining in this chart. So
so
yeah,
in an
please go ahead.
equal weight, if it's, let's say there's an S&P 100, it's 100 stocks. There actually is an S&P 100. It's the 100 biggest stocks. But the bigger the company, the higher the percentage in that index. In an equal weight, if there's an S&P 100 equal weight, which for that there isn't, but the 100 shares or 100 stocks in it, each stock would get 1%. And as the company grows in market cap, every year it's rebalanced back up or back down to 1%. So what happens in an equal weight index is you end up selling winners to buy losers. Whereas in a market cap weighted index, you usually end up selling losers to continue buying winners. So you're essentially betting that the companies that are winning will continue winning, and the companies that are losing will continue losing. It's strange that selling winners to buy losers over the long term ends up being a slightly better strategy if you go back to inception. I mean, these past 2 years have really brought that performance back in line. But if we're looking, if we'll, I believe I have a chart of this. I'll show it to you in a second. But we were talking about equal weight. I mean, look at how many active U.S. fund managers underperform the S&P 500 equal weight.
Wow.
It's usually a majority of them. The only time they don't is when there's a massive surge of breadth. I mean, 2021, 2020. So excuse me, 2020, you had most fund managers beating the equal weight because, well, if everything's going up, I mean, it's one of those years. But so yeah, it's hard to beat. And then even if we compare the S&P 500 equal weight by various styles of funds, it's hard to beat on a rolling period. So a rolling period is just the past 3 or 5 years, for example, and the performance averaged between on a yearly basis. So all domestic funds, 90% of active managers don't beat the S&P 500 equal weight.
Wow.
Who
So
keeps
just to
who
put
who
it
did the
in,
best? Who did the best for the past 3 years? At 83%. Oh no, small cap value 63%. Small cap value beat, well, about 47% of small cap value managers beat the S&P 500 equal weight. Interesting. But how many? Okay, well then let's think this. How many of those small cap value managers are, I don't know, deep value managers? I but
So
yeah,
it's
no.
it's
So
it's so
over a 20-year
crazy.
period, I don't think anyone is higher than 95, and that's still a small cap value. I wonder what that 20-year annualized number would be for small cap value if they didn't have such a good period in the past 3 years. It'd probably be back to 98 or something. All right, we'll count that as an outlier. Who scores the best? Mid cap growth or a mid cap value? Okay, mid caps. That makes sense. If the equal weight is more in market cap relation, if it's more closer to mid cap than your mega cap, then I'll give it to the mid cap managers. But yeah, like you were saying, if we go all the way back in time for when all four of these indexes shared the same inception date, well, I don't know when that is, but for this I did 2000, right? Look at the S&P 500 return compared to the mid cap, small cap, and the equal weight.
Wow.
So there's two major points to this. Tech bubble. After the tech bubble, larger cap names just got absolutely hammered for 2 to 3 years, and the mid and small cap names, they always have more volatility. Once they bottom, they took off fairly strongly, and then you had 2008, so you saw your portfolio get split in half again, second time in the decade. But if you didn't have allocations to mid and small caps, it took you a much longer time to recover in performance. So right now we see these large cap names dominating the market, right? And what does that bring to mind for me? We saw the chart earlier where mid and small caps and equal weights have been relatively flat for 3 years. And we don't see times like that often where 3 to 5 year annualized periods for these parts of the market, they've just given investors nothing. So to me, that shows, okay, when markets do shift, their time will come, and now is now is a better time to buy names like this than when they do start taking off. Because we
So
saw in
this is
November, inflation came in at 3.2%. These things returned more than large cap names, right? So if you're waiting for a catalyst in the market for a breath rally, rising tide lifts all boats. I I mean, the market's expensive, the S&P 500 is expensive, mid and small cap names, and on a valuation basis, we continue. They're cheap as ever.
absolutely, absolutely. So you bring a very important point, and I just wanted to. So can you go to the previous slide? I just want to
Yeah.
simplify things a little bit. So for the people, and I am the best example for it. So for a very long time, since past 3 years, I used to believe that market weighted S&P 500 is probably the best instrument in the history. But sure enough, I didn't go long back to 2000s and then compare the market cap weighted S&P to the equal weight and the mid cap and the S&P 600. So this is a very very interesting chart because this shows that if you go back 2 decades and then you objectively from a very top level view analyze, then you'll come to know that equal weight outperformed smashed in terms of performance. So for the people like me who came into workforce in nearly 5 years ago, for us, market cap weighted Nasdaq or
But
market cap weighted
I'll
S&P
stop
is
you
the
right
best
there.
thing.
But it is the best thing. But trying to find what's the best thing, the S&P 500 Nasdaq or an equal weighted Nasdaq or an equal weighted S&P, starting points matter. So this chart is very reflective of, I'd say, long-term trends, like decades
Hmm.
long. But this chart starts at 2000 when large caps were getting beat up, and the smaller names outperform into 2008. And then in 2008 to 2010, you had a low interest rate environment, which helped small and mid caps even more. So you already have two catalysts helping them out over the past 20 years when you look at this chart. But
Hmm.
if you were to stop in, I don't know, in 2013 or 2015 and look at performance, I'm sure the chart would tell a totally different story. So if you're going to look at small caps, mid caps, and equal weights, they'll always outperform when your starting point is a time of stress. So you find a stressful time in the market, like now where large caps are totally outperforming. I wouldn't be surprised if small caps dominate over the next 5 years once inflation and interest rates come down. So
So you right now, so
starting
you right
points
now,
matter. So don't say that the equal weight is the best thing. It depends on what the starting point is and what market conditions are at the time you're buying.
perfect. You actually answered, the question that I was about to ask, because a lot of viewers are going to start their investing journey, let's say right now or in, coming 2 to 3 years, because that's the average age of the audience who is watching this channel. So the burning question that they had is, okay, now I got a new job. I just came into workforce, got married, and now what do I do? So that's the very important answer that you gave. So if we are starting right now, so probably equal weight or probably S&P 500 or 600 would be a much better option, since the top 10 or top 20 are taking the major part of the pie. So there's not a lot of growth runway over there. So yeah, I mean that's for someone. Yeah.
Yes, no, no, go ahead.
Yeah. So for someone who's starting, probably this is a good point to watch. Probably a good thing to remember.
And like we were talking about valuations, I mean, look at look at the weight of the top 5 stocks in the S&P 500. They're 2.35 times more expensive than the Russell 2000. This uses the Russell 2000. This uses the Russell 2000. This doesn't compare to S&P 600. Um, and similarly, if we look at large and small cap names, roughly the same valuation differential compared to large caps. So if we take this chart does use the S&P indexes. So this is S&P 600 and 400 compared to the 500. So like we said, starting points matter. I mean, I don't know when the tide turns, but nothing lasts forever in this business. So this is one thing I have been keeping an eye on a lot since probably November.
So
Not
this
even
is
November, maybe
probably,
since last summer.
yeah. So like to put it in simple terms, like valuation wise, probably this is much better deal right now.
And the thing with mid caps is, I think I think mid caps are the best of both worlds. You don't have that risk of small cap, but mid caps have another advantage. The most M&A activity happens in the mid cap space.
For sure, for
So
sure.
that's
For
something that's adds a little plus to if you want to choose between mid and small.
For sure. So there are so when I'm just wearing a hat of a common person who
A
wants to
retailer.
yeah, a retailer. For people who wants to play with fire, who wants to go with IPOs, and who wants to find a multi-bagger, probably this is much better strategy. So here in midcap you get exposure or a promise of higher scope of growth, and at the same time the risk is probably way less than the small caps or micro caps.
Wouldn't
So
say
this is
way
a very,
less, but just
I mean,
maybe
yeah,
a tad.
yeah. At least it's not like same as micro caps or startups. Like they don't blow up overnight. I mean, I mean the chances. So we're
And
talking in terms
speaking
of
of
probability.
IPOs, I mean, I guess if you're an IPO investor, what IPOs? There's been maybe 3 or 4 major IPOs in the past 4 months. So, I mean, Reddit was one. What ARM Holdings,
Yep. So
IPO
as
was
opposed
another
to
high one.
that, yep. So as opposed to that, it would be better to go with mid caps. So that way you have the exposure also, and then you have a good risk reward sweet spot.
Yeah, if we go on the last slide or 2 slides,
Hmm.
mid caps were best performing from 2000. So yeah,
Yep.
and then we were talking about earnings growth when we first
Hmm.
started our conversation. And if we look at who's so this is from earlier this year and last year, and I keep hearing it on a variety of conference calls from different managers, and it's that small caps are expected to grow their earnings more than large cap names, which I'm happy to hear for someone who's been getting sick and tired of 7, 8, 10 stocks dominating the marketplace, only companies growing their earnings really. Then hearing things like this and starting to see them, happy as can be.
For sure, for sure. Like, don't you think like this has been a story since past, you know, uh, let's say 5 or 7 years, where all the FANG names used to dominate before pandemic, and then after pandemic we have Mag 7. So if the markets, if the capital markets in general are moving towards a direction where an era of winner takes all, like, so don't you think that it's not healthy? And if yes, then how, what is going to
Uh,
stop? You know,
I'm gonna answer that question in two parts. I mean, before the pandemic, I wouldn't say just larger cap names were dominating. I think that's I don't know what kind of bias. What would we call that? Visual bias, because larger cap names are what you see most on TV. Mid cap growth was crushing it before the pandemic for a few years. I think more than large cap. And then after the pandemic, mid cap growth was doing better than large cap, because the S&P 500 will reference for large cap. By nature, it's more growth oriented because we have more tech communications companies in the United States than we other developed countries do. So if you're going to focus on a lens of growth of large and mid was doing good before the pandemic, and a year into the pandemic, mid was doing very well. But once we had higher inflation, higher interest rates, the larger cap names took spotlight. Now they've gotten so big that we haven't seen for a long time, and they're doing very well in terms of earnings. Winner takes all. Yes, we do live in a winner takes all world, but right now with the winner takes all world, it's we go to the AI story, right? And who's the first to roll out AI features? It's going to be Apple, Microsoft, Google. Who's building the chips for it? Nvidia is. So there's been this trend of where everyone name drops each other on conference calls and on earnings calls. And I mean, when was it? Last month, there was an NVIDIA presentation. They made it
yep,
like the Coachella of the tech world. And they had every company they do business with on in the background.
yeah.
And when you listen to a conference call of NVIDIA or Amazon or Meta, they're like, we're buying this many NVIDIA GPUs. And NVIDIA will be like, oh, we're doing business with Amazon, Facebook, Google. They place this many orders. And then Google and Meta will be like, oh yeah, we're working on this AI together. Well, that's powered off NVIDIA GPUs. So it's like a college party. Oh, do you know this person who's inside? It's his house. Can I get in? Everyone's just name dropping each other. And when they name drop each other, their stocks go up. Next week, you have the same thing. The companies start name dropping each other, their stocks go up. So this trend, I don't think is sustainable. It's like in 2000 when the world thought everything's going to run on Cisco voice over IP. I guess
So
until someone builds a better chip, everything will run on NVIDIA GPUs in the near future.
So just to add on that point, so recently, I'm sure you might know this, but recently I read an article from Sequoia Capital, one of the largest private equity, player in the market. So they put out an article stating that the investment in AI chips went 30 billion this year. So people collectively spent 30 billion. But interestingly, the difference that that investment made in terms of top line, that is revenue, was 3 billion. So I just wanted to, after hearing this statistic, I just wanted to hear your, conclusion or inference from this. Like, when is it going to be too costly for companies to, ask, like, if it's not bringing a formidable difference in the top line and bottom line, at what point do you stop pouring billions of dollars into some technology? So that is where, the tug of
It's
war is
it's
happening.
it's too new. I can't really give you a confident answer. Um, it takes time to roll out. We haven't really seen much of a rollout in some of these technologies except GPT and some fairly common LLM units. I use ChatGPT. I haven't really messed with Bing or Copilot, but we haven't seen other applications of this. We haven't seen it in Microsoft Office on Word or PowerPoint and things like that. We haven't seen it in Google's Office Suite for Sheets or Gmail. I mean, think about Apple. Siri is the dumbest AI at my disposal. Like, what does Siri do? The only thing it does is set alarms and reminds me of stuff. I think if I'm paying $1,500 for an iPhone, Siri should be doing some more grunt work for me as my own daily personal assistant. But no, nowhere close to that. So they have to continue pouring money into these chips to make some of these new technologies coming out more adaptive, everyday, accessible technologies to everyday people. And not only that, they have to be able to make them idiot proof. So easy that a fifth grader or somebody's untech savvy grandma can use it in different languages. So I think they have to continue pouring money into this space.
But then, don't you think that there's a cost to innovation, right? Like, how long can you fund a project, without seeing real good outcomes?
How long
Because
did
so at
how
some
long did
point,
Uber subsidize rides until everybody had Uber on their phone?
I mean, so this has to stop somewhere, right? I mean, that
How
was
how long
backed by,
how long did DoorDash continue pouring money into user acquisition costs until people realized I don't want to drive to the food place. I'd rather just get it delivered and pay $3 or $4 in tip and delivery fee. It's
I
the same
guess,
thing. And I think the players who can roll out AI tools the fastest have more money than they know what to do with. It's not like they have to get VC funding and pour pour out debt at higher interest rates the way DoorDash or Uber had to. We're talking about Apple, who's I don't even know how much cash they're sitting on right now. They can continue buying chips and hire people to make Siri a better tool. And
makes
they
sense.
won't blink twice. Whereas I guess if you were Uber 10 years ago, you're always concerned, where am I getting my next
Funding round.
where am I getting some more funding even after IPO? So that's my take.
Makes sense. Cool, cool.
And I mean, if we're talking about Apple and Microsoft and those guys sitting
Hmm.
on heaps of cash, I know you and I spoke a few weeks ago, and you asked me how much is sitting around in America right now in
Oh
money
yeah,
market funds, and it's six
crazy.
trillion, 6.143 trillion. Like it's this is money that's looking for a new home too, and 6 trillion is I don't know even if 5% of this goes into equity markets, it's a nice boost. I don't know if I wonder how people think about the election, and I know like retailers specifically, retailers are always looking at headlines. When do they go time to get out of money market funds and into equities? I know interest rates are money markets are paying anywhere from 5 to 5.5%. So that's that's an investment. But when cash is no longer king, I guess they're just waiting for interest rates to come down.
Makes sense. Makes sense. So just for the viewers to understand, make a note of this. This is trillion T, six
With
point
a
one
T,
four with a T. It's
with four
though that,
commas, four
yeah,
commas.
yeah. So it's like $6.143 trillion. Just to put that into perspective, it's almost 25%, more than 25% of U.S. GDP.
This is the equivalent to the market cap of the Fantastic Four.
Exactly, exactly. And that much capital is sitting on the sidelines waiting for the right opportunity. So good luck finding, bigger corrections, more than, 10% or 15%. So from a
Not to
retailer
mention that
hat, uh,
we're also in a market where share buybacks are coming back.
yep, yep,
So if Apple issues a share buyback, they're like, oh, we're issuing a share buyback for this many shares of shares outstanding in the company. Price goes up, they start buying back at higher price.
more
And
up.
then
Yep.
when the price goes even higher, they sell them to you at that price, and they work like their own brokerage.
Makes sense. Makes sense. So, just for people that don't know, share buybacks are, a practice where management decides to, buy back its own shares so that, not only the outstanding shares, reduce, but the existing investors get rewarded for having a larger pie, in the ownership. So, a lot of, companies, they do a lot of things to reward investors. For example, they can announce dividends, they can announce share buybacks. So that's a common practice. And what he's referring to is the buybacks are going to start pretty soon, because many a times government has the ability to create a law that, hey, for this amount of time no company is allowed to do buybacks and whatnot. So what he's referring to is the uplift of those regulations.
And I mean, if the biggest companies are buying back their shares, and let's say even half a trillion goes into SPY or S&P 500 funds, and then if the biggest names have a 30 to 35% weight in those indexes, paired with share buybacks and new fresh money, I can see big companies getting even bigger.
Yep, yep. So normally, when I'm a retailer, normally when I see, red hot headlines, hey, world is coming to an end and whatnot, and then it doesn't. So then we come to, ask questions like, why the hell it's not going down? And this is exactly, we gave you a lot of reasons why is it not going down, because at all, markets are a function of supply and demand. So if there's so much demand sitting, and we listed out a lot of reasons, then, irrespective of what the consensus is, with the existence of such high demand, it won't go down. So this is just for, knowledge, like where the money flows are coming from, what are the potential, why, financial markets don't see 50 or 30, 40, 50% drawdown every single year. It's because a lot of, market factors come into picture. So because many a times you read headlines, you read, a lot of, crap on the internet and think that, okay, we are going to have a recession, we're going to have 30, 40, 50% drawdown. And then you see only 5% pullback. So that's when you tend to, ask questions. So this is where your demand is coming from. Right. I mean, some of the factors, not all of them, but we listed almost all major,
It's like
cash
if
sitting on
demand's there
sidelines.
and the corporation itself can control supply as much as possible,
Yep. There
then
you go.
you play with your own supply demand imbalances. Let's talk about managed futures. This is something that I don't think any retailers know is a thing, just
Sure.
because managed futures historically in the past, even now, it's been an asset class for multimillionaires who have access to hedge funds, and managed futures managers are listed as commodity trading advisors. They're not listed as financial advisors. And what managed futures is it's an asset class, it's an alternative asset class because they're they're buying futures contracts on stock indexes, on bonds, on treasuries, and making bets on interest rates, making bets on inflation, on commodities, and buying derivatives for these various underlying commodities and buying futures contracts on currencies. So they're essentially making a bet on everything you can make a bet on, and they're long and short. So they're market neutral. If they think something's going to go up, they'll go long. If they think something's going to go down, they'll go short. So they're neutral, but they're also leveraged. But it's not leveraged in the sense of your three times semiconductor fund or two times Tesla or something like that. It's balanced. I don't even like to use the word leverage for a market neutral strategy, but legally it's what it is. It's the nature of it, underlying structure. So that's my way of explaining managed futures. And I like I like managed futures because I think we now live in a world where a stock and bond portfolio isn't enough. Now this is becoming managed futures are becoming more accessible. You don't have to be a millionaire to own them. You can own them through various strategies of ETF or mutual fund. So if historically multimillionaires were able to have access to hedge funds and commodity trading advisors to get an asset class that you as an everyday person can't, and now you can, I would go take advantage of that. It's like an insurance policy. You don't know when you need it. And managed futures are supposed to do best when there's a lot of volatility. And here's an example of that. I mean, so the index we're going to focus on for this is the SG trend indicator. They follow trends in the market, which currencies are going up, which currencies are going down, or which commodity or bond or equity index is going up or down. So they're trend followers. The SGCTA index is the commodity trading advisor index. There's about 30 to 40 commodity trading advisors who are hedge funds. So what these guys do is they come together and it used to be Barclays. I don't know who it is anymore because now with the whole Barclays getting bought out by UBS, a lot of stuff's changed. So they may have sold this index to another company. I don't know who it is anymore. But the CTA index is these 30 to 40 managers who come together and they sell their daily holdings to the index so that the index can take all 30 of their holdings, all 30 to 40 of those fund managers' holdings, and make an index out of it. That way, these guys can compete with one another.
Okay.
and then you have the regular SG trend index. So it's a less active index compared to the trend indicator. So the trend indicator is more, this number's flashing. It's more mathematical. But I personally like the regular CTA index, just 40 firms, and you got some big names in there. Like AQR is in there, which is Cliff Asness, hedge fund billionaire. Um, he's big on managed futures, alternatives, and using principles of, he hires a lot of mathematicians and physicians, not physicians, excuse me, physics
Yeah.
professors to manage money. And so if we look at this chart from 2000 to 2010, if you were an equity investor, just the S&P 500 got cut in half twice over that decade. It was a very volatile decade. It's called the lost decade for a reason, because over 10 years your return was zero. So you lost 10 years of your investment life. But managed futures during that decade, they doubled your money.
Wow.
Or these indexes doubled. They didn't double your money, but the indexes doubled, which we see here, right? So that concept of they're an insurance policy and they do best when there's high volatility in the market, that held true that decade. But then what happened after 2010, after that whole lost decade, is we had no market volatility, because in 2009 government bailed the banks out, and then the Fed and US government, everybody was just so up in every company's business of, we can't let this fail, we can't let this happen, we have to backstop everything. So the government and the Fed acted as a backstop to pretty much all volatility. We even saw this in 2020.
Yep.
You get some free money. We're gonna roll out this program for these people. Everything was just overdone, in my opinion. If you have a different opinion or you want to get pissed off at me, sure, shoot me a LinkedIn message. I'll argue with you.
No, no,
But
I'm of the same opinion because
great.
what
Now the viewers can argue with you too.
no, no, I'm of the same opinion because I believe in free market, free capitalist economy,
So
and if you don't
in those markets,
let,
managed futures would do great.
yeah, yeah, yeah,
So, but I mean, so then the decade after, like I was saying, it was a lost decade for managed futures.
yep,
They returned zero, whereas the S&P 500 up 250%. This is data from January 1st of 2010 to, what's today? April 16th.
yep.
I pulled this up today. So yeah, a lost decade almost for managed futures. But you can see, like in the past 2 or 3 years, they started to have show a little bit of performance after
Yep.
2020, and once inflation, interest rates, and commodities started making their way up. Excuse me. But I think I think managed futures, it's an asset class that helps makes portfolios more efficient. So if you have a stock and bond portfolio, and what was it? 2022 stocks and bonds moving in the same direction. Managed
Yep.
futures were moving the opposite direction. So it puts you a little higher on that efficiency matrix. And
So,
this is
mhm.
something that I doubt viewers really know exists.
Yeah, I mean, a lot of, probably, major chunk of retailers don't even know that such kind of, products exist. So, all, they know, or all we know, to be honest, is if we want exposure to any, futures products, then just trade directly. But these kind of regulated products does exist is a very good thing to know. And the second good insight that I took from this is the standard stock and bond portfolio. You don't, it need not be the same. You can have a different asset class that is this one to hedge against those years. Because imagine telling someone that my portfolio outperformed in 2022, you would be a rock star. But if you had a good, you know, smart allocation of managed futures in 2022, then yes, you would have safeguarded a lot of performance backdrops that occurred due to
That's
stocks
actually
and
what
bonds.
happened to me as an advisor with having managed futures in smaller and mid cap names. Everyone thought I was some sort of god, but then 2023 hits and only 7 to 8 names are performing, and then everybody's like, "Hey, what are you doing? Aren't you supposed to be managing my money?" So that's what that's it's one of those things where you can never win in a concentrated market. Not just me, a lot of advisors, and a lot of people did fire their advisors and hire new advisors, but it was it was it was the same problem. It's a problem for the whole industry, and it's one of those things. If having diversified portfolio is the right thing to do, and it meets a client's goals and risk tolerance, then if somebody wants to beat up their advisor over doing the right thing, that's on them. And I guess that's also an advisor's problem, which I think I've faced too, is not educating clients or prospects enough on what it is that I'm doing for them.
Exactly. So here I want to make a very important point for all of the viewers watching this. Always, like, normally a retail mind focuses on returns, but also make a due diligence and try to know like where that return is coming from, because that's how you will become a much better informed participant in the market. Because what happens is people get enticed by the numbers and the absolute percentage, but they underappreciate that what has been done by the advisor and how is he safeguarding your portfolio. So that's a very underappreciated fact by a lot of clients. So I just wanted to put it out there that giving your money to someone is a good thing, but also actively involved and actively reading and appreciating what kind of work is done is equally important, because that is going to make you a better investor over the longer haul, right? So just wanted to put this out there that the
I
reasons.
think it's important for viewers to know that if you work with an advisor, it's try to try to work with someone who you can, call at any time, even to be like, hey, I know UBS, when I used to cover a sales desk at a company and I worked with UBS advisors, and I always laughed because some guys in their biographies on their website, they would have like, here for all your needs, even if your kids want to know if Santa Claus is real. So someone who you can call and just ask anything and is there to educate you and give you an answer. Or if they don't know, they can find out in a couple of days. Those are, in my opinion, that's who I strive to be. If someone has a question, I try to educate them or I try to find out.
See, that is why we have you over here. This is really important because I don't blame a lot of people, because many a times what happens is they don't they try to go for big corporations, but a lot of them don't have an incentive to be involved at such a high degree, because
And
they only care about big clients, and rightfully so. Like,
how
there's a
much
resource
commission am I
allocation.
earning on a yearly basis? Well, that's
Exactly.
that's the problem with once you get so big, like you work at one of the biggest wirehouse firms as an advisor, and you have over 1,000 clients, and you have a team of only 2 to 3 people. How can you constantly stay in touch with everybody? I mean, I've seen people who have advisors, and they're like, I haven't talked to my advisor since we opened the account. And I'm like, what?
Seriously. Wow.
You've been with this guy for 15 years, and you've never spoken to him since? And they're like, yeah.
Oh my God.
So, and there's and then forget about the big companies. There's a lot of mid-sized companies too, and you see this problem in small town America where someone will have a retirement account and they've had the same job their entire life in a small town, and then they'll be like, these are my returns, my guy's not really working for me. And I'll be like, what do you mean? And you'll look at the fees and everything will seem fine, but then you'll start seeing things like platform fee or like market data fee, and you'll see that those things end up being 1.25%, and then they're paying a 1%
Wow.
fee to the advisor. So I some things that are out there that not even I understand of why things aren't just clear cut, makes sense. Everything's easy to view, read on a statement. So
See, this is why we are fortunate to have you, because many a times people don't, honestly, I don't blame them. People don't have time to research all these things. And the problem is their ignorance, people make the most out of other people's ignorance. So this is why, we discuss all these things over here so that people understand what they are, opting for. So you do a lot of research, you do a lot of reviews, and you watch everything for just buying a $10 thing. And but when you deploy thousands of dollars, and if not hundreds of thousands of dollars, why don't you do the same due diligence? So this is where people need to get educated, and what better than the people like you who at least can be reached out to, at least who respond. I have seen certain disformities where you just talk to your advisor just once in a year, like that's it. So I mean,
well, so it's like one of those things. Some clients it's like there's all types of people, right? There's some people who want to talk every week about what the market's doing. There's some people who don't even want to talk once a year. It's to each their own, but I think you should at least talk to someone managing your money once or twice a year, the same way you talk to your accountant once or twice a year.
Absolutely, absolutely. Sure. Yeah, over to you. Let's continue.
Yeah, so I mean, we were talking about Nvidia, but let's talk about the entire semiconductor industry, right? And I think Nvidia being the biggest company, being the biggest innovator, and as well as TSMC, I mean, I'd say what 80 to 90% of America's most advanced chips have a hand in TSMC, or TSMC has a hand in helping build those. And ASML has a monopoly on building
Lithography. Yep.
machinery for a lot of these chips that are made that are used in everyday life that we don't even think about, whether it's our computer, whether it's our cars, which cars now have twice the amount of chips as before, because now we have these fancy LED touchscreens and we're getting rid of buttons and knobs for touchscreens plus self-driving and things of that nature. Now with AI being put into various parts of everyday life, whether it's Microsoft Office or like we were talking about Siri on your phone, if it's not directly inside that piece of technology, there's still something on the back end in a data center, or even going as far as a cybersecurity software that's on some of our devices, or what a company that creates something is using cybersecurity for, and all of that still requires hardware to be processed. So there's a lot of things that people don't think about, and in recency bias, we get pulled towards NVIDIA, but it's a big universe, and it hasn't been treated the same in terms of designers and equipment, or in terms of designers, equipment, foundries, raw materials. And I say this because the sexy designers have taken a bulk of the performance in the space. So if someone has a monopoly like ASML, or is a foundry like TSMC, I want to say they've been late to the party. So if AI is a gold rush, excuse me, if semiconductors are a part of that AI gold rush, like we said, everybody wants what's sexy. So everybody wants the designers, but nobody wants to reward the people in the gold rush who are selling picks and shovels, like the equipment manufacturers, the foundries, the raw materials producers. So I think it would be very interesting to see if what happens if we take just the stocks of the designers, and then we take everybody else, get rid of designers and everyone else,
Hmm.
and let's equally weight them, since we like equal weights. We'll equally weight them, and we'll see who's got better performance. I guarantee you it's going to be the designers.
Yep.
So I think if you feel like, not if you feel like, but I think they've been unfairly treated, is what I'm trying to say.
So don't you think that there can be genuine
Catch
logical
up.
reasons? Sorry.
Oh, sorry. Go ahead. Changing logical reasons for why
Yeah.
equipment.
Why these? At least not equipments, but at least the foundries. Because what comes to my mind is like foundries are the manufacturer of the chip, so without them nothing is possible. But at the same time, that task is so damn capital intensive that as if I look from a lens of a business, the margins and that thing gets crushed. So if that is true, then why would I reward it with high valuations? That's first question. Because my logical brain tells me that if TSMC is so good in terms of as a stock or as an investment, then why haven't it grown over the years exponentially, like as an investment? Because the last time I saw TSMC in the news, Mr. Buffett withdrew it unusually within a very short amount of time. But
Yeah, it
I mean,
is like you said. That's I agree with you. It's most likely why that their stock price appreciation has lagged the designers. It's capital intensive. It takes a great amount of capital, manpower, and time to change processes for a new chip. So
and also with the equipments, right? So you mentioned ASML. So that is the only company in the world which manufactures the lithography machines, which actually does the chip design. So what comes to my mind is, yes, ASML as a technology company is amazing, no question. But when I look at that company as an investment perspective, there's no scale, right? Like I can only ship, let's say, hundreds of machines a year. How am I going to achieve growth?
Okay. Good point. Good point. So I get what you're saying, and I like what you're saying. I agree with you. These are things that I had not thought about. I'm not as I'd say you're in the space. You're dealing with these companies and these
Yeah,
technologies on a daily basis. So
yeah.
those are good
It's
points.
just
And
that.
what comes to
Mhm,
my mind is it's like being,
mhm.
I don't know, it's like being a salt manufacturing facility. You have one mine. Oh, people are ordering more salt, but now if I want to process more salt to sell and grow my revenue, I have to create another assembly line of people mining, processing, cutting, packaging, and selling. So it's more traditional, lower valuation, and
Yep.
less growth. Fair enough.
Yeah, because the thing with these, so I myself in my daytime job, I myself I'm in hardware business. So even after giving great numbers, even after having great supply chain, um, hardware businesses tend to win less valuation or less multiple, so to speak, because the reason is like as I say, the scale and the sustainability of that. Because these things, it's very hard to sustain and ship 20% growth year over year, right? Like who the hell? Because all the customers are commercial, and once you establish a plant or once you establish a thing, you don't need it. So that brings me to one next thought that yes, people right now are buying like crazy the chips, right? And that is for training data. So for training, you need much higher compute power. But as and when you don't need training, now you just need inference, then that is going to require very less amount of compute. So then the demand dynamics is going to shift. So
Demand shift. So I guess if you're a foundry, you don't want to just
exactly,
build two,
blindly,
three more
yeah.
plants, and by the time
And
they're
then just to
finished,
realize,
there's no demand
yeah,
for it. Yeah,
yeah,
it's cyclical, and you have to manage that cyclicality.
exactly. And I guess that is why they're not being rewarded with very high multiple, because the risks are so much, right?
Risk and the money needed to
Yep.
sustain that kind of growth. And if it's not going to be there in, I don't know, 10 years, then why would you double your capacity? Not even just double capacity, where you're going to find enough employees when there's already a shortage of
Absolutely.
advanced labor.
Yep.
So,
Absolutely.
and like we were saying, like chips and everyday things. I mean, this is something from Quarter is a company that kind of revolutionized the conference call. You can listen to it on an app, and they create slides and infographics for you. And some of their things, like the chart we saw earlier in this one, they put things into good perspective, right? And who would have thought that the Apple Vision Pro uses this many chip manufacturers in its one headset? Speaking of the Apple Vision Pro, Apple's kind of getting kicked out of that Magnificent Seven we were talking about, and there was so much hype around this thing. I feel like nobody talks about it anymore. There were people at ski resorts wearing this damn thing.
Yep. I mean, so more on to this topic, since this is more related to retail. So the Magnificent Seven, right? The Apples of the world, Microsofts, and Amazons of the world, and all of these are retail favorites. When I see performance, there's a lot of churn going on. So when I entered into the industry, Netflix used to be one of the great members of this group, but uh, since past 2 3 years, I don't see a lot of talk.
No,
Uh,
no one talks about Netflix anymore.
yeah. Also, so Apple after the split, it was going sideways like crazy. If you look at 2 to 3, let's say 2 years, Apple's performance from the 2021 peak, essentially it has done nothing. I mean, almost. So when we say like these Magnificent Seven stocks, are the ones that are driving the growth in the indexes, the performance has a lot of churn, and it's very hard to pick like which of these Magnificent Seven is going to perform for the next 2 years, right?
Yeah, yeah. Like
So,
Tesla's getting kicked out.
exactly, exactly. So
Apple's
I
getting kicked out. And I think the thing with Apple is paired with China sales and the fact that, I mean, I don't know, this iPhone 15, how I don't need a new iPhone every year. if everybody's got an iPhone from the past 3 years, what's the point of buying a new one all the time? I'm a Microsoft guy. I like my Microsoft Surface, but I don't go buying one every not even every 3 or 4 years. I've had this laptop for 4 years. I guess if you have a MacBook, you keep it for I don't know,
At
at least
least
3 years, at
at
least
least
three.
3 to 4 years minimum.
Yeah.
Yeah.
So now Apple has there's more iPhone users in the world than Android users, right?
Hmm.
And if we look at just developed countries, what developed countries, probably 70 to 80% of people have used the iPhone.
Hmm.
There's always going to be 15 to 20% of Android users. I have no problem with it. I know people who really like photography will always use Android. People who like their AI tools, customizations, coding will always be using a Samsung. It's okay, but how often do those? How often does that 80% of the population need a new iPhone? So I guess now you got to make money on being an insurance company like Apple Care, being a bank with Apple Pay, being
Subscriptions business.
subscriptions for data storage, pay 99 cents a month for I don't even know how much it's full. I just don't feel like paying 4.99 a month. so so yeah, I think I don't know. I think the Apple Vision Pro was a good start. I'd like to see what new other products they have. Personally, I think it's too bulky and heavy. I've never used it. Just what I want to I want to have something like that built into my glasses in the next 5 years. That would be nice. Like Iron Man, hey Jarvis, do this for me. Hey Jarvis, pull up this stocks chart. I think we're
So
closer than we expect.
yeah, I mean, so here's the thing. I brought this topic of Mag 7 in front of you because you are someone who is very deeply involved with day-to-day, markets, and I wanted to take your opinion on Mag 7 because a lot of people are interested and heavily invested as well into Mag 7 because that's all they know about, yeah,
You're
right?
also in San Francisco, so
Yeah,
you
yeah,
have that locality bias, that recency bias, and
yep,
these things where you have a hard time getting away from things that are in front of you,
yep.
which is fine. It happens. I mean, in Mag 7. It's what comes next, who goes in, who comes out. It's hard to tell. And
So
if we go back 20
fundament.
years,
Mhm.
if we go back 20 years, out of the top five companies in the S&P 500, the only one that's still there is Microsoft, and even Microsoft got kicked out for a while.
Yep, yep. It's only after
So it's
the
it's hard to know who knows and who stays because these other 4 or 5 names, they weren't in here 10 years ago. Who was in here 10 years ago?
I think there are a lot of names that
Apple and Microsoft. That's it.
IBM.
IBM wasn't in it too 10 years ago. IBM was in it probably 24 years ago.
Okay.
10 years
So
ago.
yeah,
I
I
think
mean,
JP Morgan. No, JP Morgan couldn't have been after 2008, 2009. I think Wells Fargo was a top 10 holding in 2000. ExxonMobil was one. I'm too young to remember. So
so just to sum it all, yeah, like at least this discussion is I just wanted to put it out there that a lot of people have this idea, especially retailers like us, who that this is the current great stock and I'm going to keep it for life. But the history suggests otherwise. Like if you look at the past historical data, there's a lot of churn in the great names. So if you're thinking that, hey, I'm buying such so and so, let's say Tesla for life, uh, understand that there is a
oh,
high degree of risk,
this you
to
just gave me a great idea. I don't know how I would model this. I'm actually gonna write it down. I don't know how I would model this. I don't know how I'm gonna figure it out, but it would be really cool to see. What if you buy 500 stocks every year, and based on the S&P 500 rebalance you keep, you whenever a stock hits the top 10, you sell it, and you just continue doing that. When new stocks get listed, you buy them in the S&P 500. But every time any stock ends up in the top 10 or top 5, you either cut its weight in half or sell it entirely and never touch it again. And you repeat that cycle for 20, 30, 40 years. What would your return be compared to the regular index? Something I'd like to know. Because we're talking about equal weights, right? And rebalancing, selling winners to buy losers. But what if a company that's just entered the top 10, you just outright get rid of it, never touch it again? What does your performance look like?
I guess you have to use your proprietary software
Yeah.
to do that modeling
My
because
my softwares can't even do something like that. I don't know. I'll figure it out. But
Cool.
always
That would be interesting,
sell
to
top
see.
five, buy rest. Because now you've just taken the equal weight rebalance effect and just blown it up to a bigger scale because you're always going to be, I'd say, every year for 10%
Yep.
you'll redo it. But then I guess what happens if you sell a company? Never mind. It's just an idea. Let's see. Let's see if I can make something of it. I don't know.
Cool. Just let me know what's the
I
outcome
will. I will.
when you do it. Yeah.
So
So what do we have over here?
we have Taiwan.
Oh,
You asked me a month ago about
yep, yep. Sure, I
exposure to
did.
Taiwan and how much there actually is. This doesn't even tell part of the story. There was a report.
Hmm.
So Michael Sembalest is my favorite, I'd say, author on Wall Street, and he does great research. Very smart guy. He is the CIO of J.P. Morgan Private Bank, and he writes what's called Eye on the Market. I think once a month, every month and a half, and his reports are very worth reading. So you also mentioned Doomsday of where earlier where
Yeah,
the
that would
world's
be
ending, right?
interesting.
He writes a
Yeah.
paper called he wrote it back in, I don't know, over 15 years ago. He wrote the Doomsdayer, or no, he wrote the Armageddons over 15 years ago. He wrote version 2 in 2020. That was a great read. Every year he has what's called the U.S. energy paper, the global energy paper. That's a
Hmm.
great read about how energy trends are playing out in the world. And recently his Eye on the Market focused, it was called The Good, the Bad, and the Ugly. And
Hmm.
he takes really big issues in the world. For example, China and Taiwan are semiconductor reliance. What if there was a war? So he puts into perspective of best possible outcome, neutral outcome, and the worst possible outcome. How many lives could be lost if a war were to play out in the South China Sea?
Hmm.
And in it, he wrote, if you thought that European reliance on Russian energy was catastrophic to Europe, you have no idea what's in store if China were to somehow annex Taiwan with some form of military strategy, because global semiconductor reliance on advanced chips is 90%. Global reliance for general chips is like 65%. And US semiconductor reliance, I said it was 90 earlier. That was my mistake. I meant global reliance was 90%. US exposure to Taiwan for logic chips is actually 40 to 45%, but that's still a lot in it. And I know these past few months TSMC has had some beef with the US government pulling certain subsidies for their plant in Arizona.
Hmm.
But this is something that I this is a report I really like reading. Anything Michael Sembalest writes is very insightful. It takes a while getting used to the terminology used if you're not in the financial services field. But I feel like if you're an everyday person, the more you read it, the more you'll learn, and you'll be reading these reports religiously in no time. And it's this is my favorite thing to read. Speaking of my favorite things to read, I'll touch on that. Who is it? Let me pull something up here. Sorry, I was blanking. Capital Markets Outlook, Bank of America, Merrill Lynch. Every Wednesday they publish their Capital Markets Outlook, and that's probably on top of my reading list every Wednesday night. Like I said, Eye on the Market, Michael Sembalest, J.P. Morgan, Private Bank. You can just Google these things if you're listening or viewing. Um,
Sure.
Bridgewater. Every quarter, every like month and a half, 2 months, they'll have a very interesting macro report. And yeah, those are probably my top three things. And then State Street Spider Insights. They have an ETF. They have like a monthly and quarterly ETF outlook with their best and brightest ideas. That's pretty solid. I have a bone to pick with Vanguard. I think Vanguard is a little too bland in reading material. It's kind of just like just buy an index, sit on it for life kind of material. BlackRock is too all over the place. It's hard to decipher what's uh, what's worth reading, what you should skip on, because I think BlackRock is just so big. They have so many portfolio managers. They have so many branches. Of this branch deals with financial advisors at big banks. This branch deals with financial advisors at RIAs. This is an institutional branch. This is material for retailers. It's just so much shit, and I think they organize it so poorly. I just don't read it anymore, to be frank. And I think RBC surprisingly has a very good U.S. outlook that's worth reading on a quarterly or annual basis. even if it's just once a year. It's I do actually, excuse me, twice a year. They do annually and biannually. So that's probably what's on top of my reading list. And then if you really, really, really want to nerd out, Google Goldman Sachs research. If you want a 30-page report that'll put you to sleep. Um, but it's if you're gonna nerd out on some investment and finance, their report, it might be 20 to 30 pages, but it's Goldman Sachs research does a solid job of different topics, different ideas around the world, different asset classes, and so forth. It's better than these things. I think are better than the Motley Fool Wall Street Journal. So there's good information out there. The problem with retail information is you don't you never think to let me go to a source that has skin in the game. Let me go listen to people who have skin in the game, what they're thinking, what their ideas are.
So this
And
is a really important point that you made, and let me reiterate some of this into simple terms. So, as you rightly pointed out, like normally the source of information which a retailer refers to is normally some kind of marketing blog or some kind of favorite website or something. But
CNBC,
yeah, CNBC, mostly
pundits.
for yeah. So like Jim Cramer, yeah, but the thing is, people. So all the sources that you mentioned, are coming from the best in class, like State Street Capital or Vanguard or BlackRock or Goldman Sachs. Like these guys are sharks. Like these guys are real Wall Street participants who have excelled over the course of years and who are dealing in size. So it makes sense. It is much more insightful to read their opinion as opposed to some media company, right? So it's really important for someone who really wants to read and who really wants to increase their financial knowledge or at least have some fair idea about being an informed investor. It's really important to actually go to Wall Street firms as opposed to other sorts of marketing agency. So
Yeah, I mean,
it's
like CNBC, it's a news website, it's a news channel, right?
yep,
What's the number one goal of a news channel? To make sure the viewer doesn't change the channel. So they don't have your
absolutely,
best interest at heart. Or even when someone like Bill Ackman says, "Oh, the world is ending," and why would a billionaire go tell you what he's doing with his portfolio
yep,
when
yep,
he's managing more money than God? Or Jamie Dimon saying rates are staying higher for longer, the inflation's going to go even higher from 3.5. We might be looking at 6 or 7. Even bank CEOs you have to take with a grain of salt. They're trying to boost their own business. If this man comes out, the CEO of the America's biggest bank says rates are going to stay high for another year or two, inflation's going to continue increasing by another 2-3%. He wants more of that certificate of deposit
absolutely,
money, excuse me. And so even with some of these reports of asset managers, you have to I even have to ask myself if I'm reading it right. So for example, if someone's a company and their specialty is bonds, they're not going to be as bullish as another asset manager, an ETF or mutual fund manager whose specialty is equities. They're going to always be more bearish. They want that bond business from advisors and clients and retailers. So their outlook is going to be different than someone who's super aggressive. Like if you go read an outlook from ARK Investments, it's going to be
oh my
totally
god,
different than, I guess,
oh my god,
a bond manager's outlook
yeah,
on the economy and general state of the market. So you have to, it takes time to learn how to cherry pick these things of who's good at what. Is this report worth my time? What's my own opinion? How do I make it all line together in terms of research?
absolutely. I mean, so the problem with this age is there is a lot of information, lot meaning a lot, but if you want to find real meaningful insights, there is no proper filter to recognize and to understand, okay, where's the vested interest coming from, whom should I listen to, what actionable insights should I grab from this report. Like all of these things takes a real expertise, it takes real amount of experience, so to speak. So before coming to a conclusion directly from a mere small blog, you gotta know like what you're doing. So that's where we are coming from.
And
So
then you have to get a step ahead of it and ask yourself, okay, this is what this research says, and these are my thoughts after reading all these things. Here's my view. How long can I keep this view and what new information has to present itself for me to change my view. And what's the time frame looking like? So you're managing essentially annualized time frames. So you're not just, you shouldn't invest looking at, if you're going to be active, sure, you can use passive funds to be active. That's still a thing. That's how I manage, right? I'm looking a year out. But then, for example, if I'm looking at those, we saw those valuations on small and mid caps. And when they get to that kind of drastic differential in valuations compared to large caps, then I don't want to just look a year out. Because what if that valuation, what if interest rates and inflation don't trickle down to towards 2%? Then I got to increase that and be like, okay, I'll start a position. I'll add to it if it doesn't continue running, and I'll continue adding to it because I want to buy this subsector of the market for 3 to 5 years because they've been left for dead for 3 years. They're flat for 3 years. And I know that eventually when the market turns and that part of the market starts to perform better when they have less interest expense, I want to be prepared for that. So you can't, it's not just like, oh, let me buy this. So it's not working. Well, sometimes you should give things time and adjust position size. So it's what I'm trying to say is that it's about how
Yep.
you implement the research and the time horizons you frame
Yep.
out with strategy, and it's not just like one part. It's
So I just wanted to
small adjustments, small adjustments.
absolutely, absolutely. So I just wanted to add to your point. So normally it's not just the intelligence, it's not just the intellect. It is also the psychological discipline. Because the problem is, let's say you researched something. Let's say from that research you pointed out a insight. Now, if your time horizon is, let's say, 2 to 3 years, you got to stick with that. The problem is people don't have that emotional firepower to hold on to the insight that they themselves deduced from their research. So that is why you need someone to tell you that, hey, this is what we thought, this was our thesis, and we got to stick to it. So as you mentioned, you're gonna double down till a certain point. So till that certain point you got to double down. You can't let your emotionality come into picture and diverge you to other path. Because what
Yeah,
happens with
not just double down. It's like if I think what I was trying to say was let's say you want to allocate 5% of a portfolio to small caps. Start with one, continue averaging in. Maybe at times you average in by only 0.5%. Well, if things are looking better than you previously thought, you average in 1%. And all of a sudden, a data point presents itself that doesn't make small caps valid. Don't average in that month or that quarter. But all of a sudden, things aren't looking as bad anymore. Continue 0.5%. Oh, things look really good. Maybe go 1.5, and then all of a sudden, oh, 3.5% inflation print. Let's pause here. Let's maybe even take some winnings and sell 75.75%. So it's very, very small adjustments until you get your 5%. That's I think it's a not safer, but I think it's a more disciplined strategy than, oh, we're just gonna go 5% and we're done.
absolutely, absolutely. I mean, so this
Um,
just got to show that this profession requires a lot of critical thinking, research. So that is why it's a full-time job. Like it's not something that you can expect to be expert at just by reading something as a novel.
yeah,
Like
I don't even consider myself, and I mean I consider myself well versed, but I
yeah,
think it's one of those businesses I never want to consider myself an expert because I think expert doesn't exist in this line of business. It's you just constantly are learning something new. Even the best investors get it handed to them.
sure.
I
Let's
think I
let's
think if you're an expert, I think
mhm.
expertise in this isn't quadrupling your money on an annual basis. I think it's being able to achieve a smooth and steady ride on a consistent basis. I think that's what expertise is for me, at least.
So this is just out of personal curiosity. So what do you consider uh, a good really above average performance? uh, let's say if virtually there existed an expert, then what would you expect? Like 15% for sustained period of time, 20% for sustained period of time, or what should be the expectation, I would say.
I'm gonna go. I'm gonna go.
Because realistically, what we read on,
I'm gonna go 8 to 12%. I think that's a healthy range. We'll put it in.
okay, okay.
We'll put it in thirds.
Hmm.
8 to 12. And there's the thing with so there's this interest. Where did I read this? It was More Money Than God. A great book. If you want something gripping to read, a book you can't put down, read about More Money Than God. It's about how hedge funds first came to be. And in one of the chapters, somebody was got this idea to short Japanese stocks. Why? Because it was the month of December. And I think it was the 80s or 90s. But the average return in Japan was 8%.
Hmm.
And the market was up 9% that year or so. I don't remember, but it was along those lines. So most money at the time in Japan was institutionally controlled or managed. So if you're a manager and the entire world, every client, everybody only expects you to make 8% that year, all of a sudden equities have returned 9%. It's December. Managers would be like, let's just lock this in. Let's just sell all stocks and buy bonds. So there was a manager in the United States, I forget what fund he was working at, said, this is what's going to happen in Japan because of the psychology of investment there. They've made what they expect in a year plus more. They're going to lock in all their profits, tell their clients, this is how much money we made you. We beat expectations. We beat the average and so forth. So all the money was rolling to bonds that year in December. So he's like, let's just start shorting Japanese stocks. And it played out. And that fund manager's managing director was like, sure, here's my blessing. Go ahead and run with the strategy if you think it right. So it's just little things like that. I think it's I don't know. It was a good book. I don't even know how we got onto this topic of books, but like if
Yeah.
we talked about blogs, what to read.
So the
Those
reason why
books,
I,
More
mhm,
Money Than God, A Random
mhm.
Walk Down Wall Street, Boomerang was very good by Michael Lewis. Flash Boys about high frequency trading by Michael Lewis. I'm a big Michael Lewis fan. His old stuff I really like.
Mhm.
So I'd say those are probably my top 3 or 4 books. There's my bookshelf over there. What else is there lately? Art of War was good in terms of psychology. If only somebody would revise Art of War by Sun Tzu and to put it into investment mindsets instead of actual warfare. That'd be nice. But yeah,
Sure, sure.
I think this is the
This,
last slide.
mhm,
Another theme I like. Oh no, it's second to last slide. Um, I guess it's tied into with the last theme. We talked about semiconductors. There's a
mhm.
shortage of data warehouses in the United States. So they just can't be built fast enough. And you wonder why we pay so much for cloud storage here in the United States. It's because it's so expensive to build and operate. And to top it off, we don't have enough of them. You go to other countries outside the US, cloud storage for pennies on the dollar. So this is just a chart showing the universe for what goes into a data center, which I don't even think no one ever thinks about it, right? I'm using this app. What's going on to make sure these things are working, or I'm on this website, or I'm streaming this video on YouTube. How is this possible?
For sure,
So
for
this is
sure.
a part of the market I like long term. That paired with cybersecurity, there's with AI comes AI cybercrime. I mean, it's already started. I know people who get calls and it sounds like someone they know, and it's not that person because you get a scam call, you say hello, who is this? They record you. That happens a few times. Now they have your voice.
Absolutely. It's scary.
So yeah, and I mean the number one phishing scams. I think they are towards Microsoft Office. So we talk about big tech investments in cybersecurity. Well, I'd like to break this chart down on the left of how much is Microsoft spending to combat, I don't know, spam emails and Outlook.
What? 2+ billion?
Yeah, this 20 after 2020, cybersecurity just through the roof. Not just
This
private
is,
sector. There was there was a guy in a California prison who somehow got half a billion in PPP loans. So
wow.
I don't know if that's like a cyber crime or how you consider that kind of fraud, but maybe government should invest more in screening different applications of various sorts too. So it's expected to skyrocket, estimated annual cost in trillions. So 13 trillion 2028. We're at what?
Wow.
We were spending 8 trillion, and we'll go to 9ish. And we have a shortage of cybersecurity staff. So I don't know. How do you combat staff shortages? You create more advanced AI tools to combat cyber crimes.
That's the only way, I guess.
So AI, semiconductors, data storage, cybersecurity. I think it's a good universe to be a tech investor moving forward.
Yep. Yep. For sure. It's so crazy. Like so what? Can you go to that slide before that? So
Oh
it
yeah.
was I was more shocked by uh, the rate of growth. So till 2020, not even half a billion, almost half a billion, and suddenly you see a
Think
spike.
about how much increase there's been in cyber crimes. Entire power grids have been taken hostage by various hackers,
Yep,
right?
power
And
grids,
we
you
see
name it,
big, like massive power grids being taken hostage. Last
you
year,
name it. Yep,
a local water, what's it called? Not refining, water
filtering.
cleaning, a water filtration plant that
Yeah,
provides
yeah.
water to a county here in western Pennsylvania outside of Pittsburgh's Allegheny County. $3 million ransom paid with Bitcoin by a small local municipality.
Wow,
Yeah, so we are outdated here in the United States, whether it's private sector companies or whether it's government run utilities and programs.
crazy,
I think
crazy.
government has it worse than private sector. Private sector will always be like, yeah, sure, let's get these softwares and new protocols. Let's get these consultants to help us figure our weaknesses out. Whereas government doesn't really, half of them don't even show up to their job.
It's crazy, man. So the reason why it's like if this growth is not linear, it is exponential, right? So this thing, there you have it, folks. I mean, if you want to choose a career or if you want to switch, this is it.
Yeah,
You
I'd
know,
go towards cybersecurity. I mean, it's
crazy.
because what? Nobody wants computer scientists anymore.
I mean,
Is that true?
it's.
You'd know better than I would.
I think the demand is only going to increase. Like I don't see even a single sign of slowing down. Uh,
Okay.
yeah, I mean, apparently people might think, but from what I see, it's not even
Because we saw a
slowing a
lot of
little
tech
bit.
companies having layoffs. I think 2 years ago, and the joke at the time was, oh, everyone used to say, learn to code, you'll always have a job. And then at that time, everyone was like, oh, learn to farm, you'll always have a job. But okay, if you put it otherwise, then I'll take your word for it. You see it on a daily basis. So
Yeah, the thing is this, right? So cumulatively, at least 80,000, high, performing engineers were laid off collectively from all the Max 7, right? So in two chunks. So 10,000 in first, wave of layoff and then the other 10,000. But here's the thing, right? Uh, any tech worker, right now, uh, so these guys who are laid off, they're not sitting at home, right? They found jobs somewhere else, right? Like so the U.S. economy is so the appetite for good engineers is so damn high that
I don't think
even if
engineers. I think any profession for that
yeah,
matter.
yeah,
I sometimes I'll in the morning I'll stop at a coffee shop and I'll just work from there until lunchtime. And I don't know, on average, one interview I see a day going on
yeah,
for some random thing, whether it's like I've overheard interviews from of bartenders, oil pipeline workers, startup employees for tech companies. That's in the past week, these three. So I guess any field from tech savvy to small
yeah,
business or to part time.
and
So I
and
guess if
that
I saw it in 1 week, it goes to show,
yeah.
yeah, we have strength in labor.
And that explains very nicely why we are not seeing unemployment numbers going tick up, right? Because people are easily able to switch jobs. So anybody who really wants to work uh, has no reason to stay home, you know.
Yeah,
So
that plus we have a whole generation of baby boomers approaching retirement.
see, yeah, yeah,
So
there
it's
you have it. Yeah,
and then the 3 million people who retired early in 2020, there was another 3 million openings. Well, in a perfect world, ideally there should have been, but
yeah.
it's
So here's the
jobs
thing,
aren't being.
right? hmm So I read a very very good statement that I found actually fascinating. So people complain and rant about, okay, we are going to get replaced by AI and whatnot. So what I read, so that statement was, you're not going to get replaced by AI. You're just going to get replaced by the person who knows how to use AI.
Use
So
it.
it's just that the field of expertise or the field of job gets changed. It's not the amount of jobs in the economy that it gets reduced. It's just the turnover of the different field. So if I'm an IT engineer, if I'm not ready to evolve, then yes, definitely I'm gonna get fired and not find a job. But if I'm ready to evolve, then there are much better opportunities, much higher paying opportunities out there. So the notion that the economy is falling short of jobs is incorrect.
It's a
It's just that
political
you have to,
headline.
yeah, yeah. So,
It's a political
that's
headline.
yeah. At least that's what I have seen. I mean, so yeah. I mean, the situation on the ground is like, if you are really talented, then maybe today is the much better time, right? So yeah.
Yeah. Any other closing thoughts, though?
Yeah, we touched a lot of topics. We touched geopolitics. We touched investment options. We touched the rational logic of investments. The last question that I wanted to ask is, so you are directly involved with the financial industry. So if you want to give a advice to a person who is not from financial industry, and if he or she wants to build a really good nest egg, what should be the approach? Passive, or like, what should be the approach? Should I just because maxing out 401k is what, 21,000, 22,000 per year, like, so that is by default a lot of people do. But what about the major chunk of money that people have at their disposal, and they have to decide, because in America, a lot of, like, the real estate ticket size for to start is very high. So normally what people do is people start with capital markets. So any advice that you would want to leave for the viewers to get started and with a right mindset, or anything that helps.
I'd go keep it, like I said earlier, keep it simple. Dollar cost average. Use the just keep it simple, keep it steady, keep adding to it on a consistent basis, whether it's weekly, bi-weekly, monthly, quarterly. You choose size and frequency, and go from there. And I'd go passive. I'd go passive 100%. I remember working in the mutual fund industry and talking to people. It's a stock picker's market, and all of the time I'd be thinking, if you were a shit stock picker yesterday, what makes you think you're a good stock picker today? And we talked, like, right, most active managers, professionals, don't beat the benchmark. So why should we be trying? So
Absolutely.
keep it simple. Simple beats complex, and stay consistent. So dollar cost average. And in really bad times of the market, maybe save some extra money, dollar cost average a bit more.
Absolutely. Absolutely. So
And
uh,
read. It's never gonna steer you in a wrong direction. If anything, you'll get more well versed. There's a very good book if you want to just learn basics. It's called the Investment Answer.
okay.
Or
Okay.
if you don't want to read the Investment Answer, you think that's too basic, try reading Where Are the Customers' Yachts. It's
Okay.
about someone who doesn't work in finance, goes to Wall Street, and he notices on the Hudson there's all these big fancy boats, and he's taking a walk with the CEO of a asset management firm, and he's like, yeah, that's my boat. And then the guy thought, well, you have all these big fancy boats managing people's money, where's do your customers or clients have any boats? And the guy laughed. So this guy got really pissed off and wrote a book on just the question you asked me, where do you start, right? And I think that book goes through the basics very well. The Investment Answer and Where Are the Customers' Yachts, they're both a very similar read, and they just start about off with, this is an ETF. This is how investment style works, value growth. This is how market caps work. This is rebalancing. This is market cap weighting. How do you blend all of that in to create your own portfolio? How do you dollar cost average it? They just start with the basics in an industry. And I think if you read one of those two books, you'll be better off than your average person to start managing your own portfolio.
For sure, for sure. I think we have uh, discussed a lot of important insights which will help people get not only get started but also which will help them to take better decisions. And yeah, I mean, pretty insightful, jam-packed podcast. So I'm really thankful. Thank
Yeah,
you
thank you for
for
having me. Let's do this again. I don't know, next quarter and 2 quarters we'll come up with a list of some more interesting topics.
For sure, for sure. But I'm 100% sure that all the viewers will get a lot of value and will be saved from doing, utter stupid things. So, backed by data. So, I'm sure, I think it was great information packed, episode. So thanks for doing
That's
this, man.
Oh yeah, you're
Uh,
welcome. Speaking of retailers, I remember walking into there was a coffee shop. I was in New York visiting a client, and this was Bloomberg Business Week about what does it say? The bull market gets weird. A band of Reddit users is hijacking stocks and defying even the coronavirus sell-off. And I wasn't visiting the client. I think I was visiting some friends at that time, but I had to buy this. And I don't know, it's under a big stack of papers. So hopefully I help some people who were a part of that crowd back in the day. I know I was big on Wall Street bets in I think like 2014. That's when there were like 10,000 people on that thing, and it was just I think it was worse with less people than with more people.
yep, yep. I mean, the problem is, uh, what I think is, whenever there is a herd mentality, the intelligence decreases, proportionately. That is what
Yeah,
I take.
I
you know,
agree. I agree.
yeah, because
But
you
also
have,
you could argue the flip side. When there's more people, the law of large numbers, the invisible hand of the market, all those things. We can get philosophical if we want to. Let's save
yeah,
it for next time, though.
for sure, for sure.
All
But
right.
hey, I mean, this was a really insightful, discussion, and thanks for doing this. And I'm 100% sure that lot of viewers are going to find great value in listening to this content, and especially taking a look at the data backed charts, and that because proof is much more easy to digest and accept. So thanks for doing all that hard work, getting up the presentation, and having those curated charts. So thanks for doing this, man.
No,
Really appreciate it.
thank you for having me.